So earnings by Access Bank, Zenith, FBN Holdings, GT Bank, and UBA, among others, defied the COVID-19 pandemic lockdown and a 6.1% GDP decline in the second quarter. The headlines of impressive gross earnings, profits, earnings per share, cash dividends have been well reported since last week. But what about the operating and other costs, the donations and impairments, among other line items? Joshua Odebisi is a banking analyst at Vetiva Capital Management, and he joins me now for a drill down on this. Thanks for coming on the show, Joshua.
Thanks for having me, boss.
Great. So where did all the profits declared by the banks in first half, where did they come from, especially in a challenging year of COVID-19?
Well, the banks mainly got their profits, they got their performance from non-interest income. I think the most important line in non-interest income was actually the foreign currency revaluation gains. A significant number of banks recorded, positive gains there. I think the only banks that recorded losses were First Bank and Access Bank. The rest of them, Guarantee, your Zenith, and your UBA, saw a pretty significant boost thanks to that line item specifically. So non-interest income was, the real story of Q2 and H1 really.
So what exactly does it mean when you say non-interest income?
Well, so obviously the banks make their money primarily from giving loans, and those loans, they charge interest on them, and that's the main focus or the main source of their income. Now, obviously in a pandemic and when you have an economic collapse like we had in Q2, a lot of interest income will go unpaid because some people cannot pay their loans. Some retail loans, like your normal payday loans, some people didn't get paid for their salary, so they would have to defer and things like that. And then you have your bigger issues like your, larger industrial loans and maybe even your oil and gas loans. So when the oil prices collapsed, a lot of oil firms might have been, in a situation where they couldn't pay down on their loans. But that was more of a 2016 scenario. This time around, the banks had learned their lesson and they had hedged a little bit better, they had provided better. And on top of that, they had also been able to restructure a large percentage of their loans. So those loans, even though they didn't get the income from them, they didn't have to record such huge losses, and they had sort of pushed them down the line. But non-interest income is the stuff like your fees and commissions. For the banks that have subsidiaries, if those subsidiaries do business and they get fees, then that goes under non-interest income. So those are the kinds of things that fall under that line item.
Interesting. So do you think the banks have also been helped to scale through this very brutal later part of Q1 and much of Q2 because the central banks had been fast and furious with policies, very unusual monetary policy tools that had been all deployed?
Well, I think when it comes specifically to the banks, the two main policies that really helped them were first the GSI, which is the Global Standing Instruction, which allowed banks to debit any debtors who had, defaulted on loans from any of their, registered bank accounts, obviously through the BVN tool. So that really helped to a lot of banks to continue to make debits and, continue to receive income that they didn't then have to book as, non-performing. And then on top of that, obviously, when a lot of the banks went to the CBN and sought approval for a restructuring of about 40% of the entire industry loan book, a lot of banks took advantage of this. And I know GT Bank, for example, for their stage 2 loans, they did about 90% of their stage 2 loans, they were able to sort of enter into arrangements and restructure a large chunk of that so that they didn't then enter stage 3, which is default. And some of them, they moved even back to stage 1, which is performing. So because of that, the banks were able to continue to make interest income, even though it wasn't as high as before. And then, the Global Standing Instruction allowed them to continue to make money. So these things really helped the banks. And then obviously the fact that the CBN went forward to devalue the Naira a couple of times also helped the banks because a lot of them had, long positions, net open positions in dollars or foreign currency, which they then made gains on, currency revaluation gains, which would have entered into their non-interest income line items. And we saw a lot of that in Q2, which really boosted the bank's earnings and also their profits.
Joshua, didn't we see last year to early this year how some of these Nigerian banks were paying down on their FX, foreign currency denominated loans throughout the international marketplace? Do you think that helped in some way? Do you think they were smart? Did they see the storm coming?
Well, I think they were definitely smart. All the banks that, cleared all their foreign denominated debts, are laughing to the bank right now. Because obviously that meant that their liabilities were down, but, the assets, they were able to boost their assets. And so when the revaluation came, even though it would have affected any foreign currency loans they gave out, and they would have had to provide significantly higher for them. I know First Bank, for example, had to do some of that, but a lot of all these other banks had sort of, restructured and written off a lot of their foreign loans and, converted them to Naira loans and gotten rid of that, of their balance sheets, which really helped them. Because when the devaluation came, it was more of a net positive and they didn't lose out through any revaluation.
So let's talk about costs here. Operating costs, admin costs, and all of that.
Right. So in Q2, what we saw was a lot of banks, your GT, your Zenith Bank, and your UBA specifically, they had significantly higher operating expenses. I know GT's operating expenses grew by about 19% year on year as a result of mainly AMCON charges, deposits, insurance charges, and a few other miscellaneous charges. And then some banks, like your UBA and your Zenith, did a lot of donating during the pandemic period for palliatives and other, corporate social responsibility measures. I know that UBA did about 4.7 billion and Zenith Bank did at about 2.5 billion. So between those two, the operating expenses went up significantly. So I think that's just, more of a one-off hit to their performance. So I don't expect that to reoccur in the second half of the year, obviously, but it did affect their costs significantly.
So in terms of administrative costs, staff salaries, wages, and things like that, did that make some dent in the second quarter?
Well, for most of them, they were able to maintain, sort of flat or, pretty manageable year-on-year growth. So those things were expected and obviously were factored in. They grow every year as, staff strength increases and, fees and stuff change. However, I think the miscellaneous charges added a significantly higher amount to the year-on-year growth, especially for your banks like your GT, which normally have very, very efficient operating expenditure lines. So that was really what increased it more than normal.
What about impairments? Because folks believe that, well, the economy was locked down, businesses were closed for some point and all of that. So how did they scale through with the provisions they had to make for impairments and all that in their books?
Well, like I mentioned earlier, the CBN, helped out with that. About 40% of industry loan book was, restructured. And this helped to push down the line a bit of the repayments. So the banks didn't have to provide for them immediately. Rather, they, provided maybe moratoriums or, just changed the figures that had to be repaid in order to maintain repayments. And so this really helped the banks to not have to record higher provisions. And then on top of that, like I said, because of the fact that they had restructured a lot of the foreign currency loans, if they had significant foreign currency loans on their books, the provisions would have gone up quite significantly. And I think we saw that with First Bank, who had to really up their provisions quarter on quarter and year on year. But overall, I think we definitely observed that the banks have learned from their 2016 mistakes, and they were able to really maintain, MPLs and provisions at a manageable rate, although they went up significantly. I know GT Bank went up from about 2 billion last year to about 6 or 7 billion this year. Things like that are inevitable, but it could have been a lot worse if they hadn't, taken some significant steps to maintain or curtail the explosion of provisions, really.
So if we start looking at Q3 and Q4, Joshua, if some of these loans don't come in good, what happens?
Well, that would be another, significant issue, although that's not what we expect. Obviously, we're starting to see a little bit of a recovery in the economy, so obviously there's, no reason to expect that these loans will not be repaid. And now, we're talking about two different types of loans. We're talking about your commercial, large industry loans, and then you have your small retail loans to individuals like you or I, who, as activities resume and salaries are paid, should be able to repay their debts, with fair regularity. So there shouldn't be any reason why in Q3 or Q4 these banks should have to record significantly higher provisions. Some of the loans that were already in stage 3 or stage 2 might go into, stage 3 and become non-performing. But I think overall, the net effect should not be too disastrous.
Thank you for your time this evening. Joshua Odebisi at Vetiva Capital Management, the head of banking analyst there. Thank you so much for coming on the program.